Okay. This photo here is taken from our SURG project, which is our flagship asset and will be the focus of what I talk about today. Forward-looking statements, of course. Okay, so SURG has been active in this district for a number of years, number of decades rather, mostly in the southern part of the district, which we refer to as our OTCQB property. We're responsible for discovering the West Seal deposit, which is part of a cluster of deposits, as shown on this map, that sit a little bit to the south, east-southeast of the Huckleberry Mine and Mill, which is one of the only care and maintenance status copper mine and mill complexes in Canada, the only one in BC. And then about 3 years ago, we started to pursue a consolidation strategy elsewhere in this district, really focused on the northwestern part of the map that you see here. And through a series of transactions with predominantly Centerra Gold, but also some individual counterparties, we've succeeded in consolidating what is now 100% interest in about 125,000 hectare land package, which is the yellow portion shown in the map here, the gray portion being Imperial Metals ground, including the Huckleberry mine that I mentioned. Big picture from the top, or from the northwest to the southeast, it's about a 50-kilometer strike length. There's 7 known copper porphyry deposits in that strike length. SURG today is about a 1 billion-ton deposit in the M&I categories, another 500 million on top of that. Huckleberry, around 35 million tons of reserves, and then between the Seal and Ox deposit at our OTCQB project, it's an additional about 450 million tons. So this is already a kind of multi-billion-ton porphyry copper district with lots of known exploration targets and other occurrences around. In terms of infrastructure and kind of where we are in BC and why this matters, it's a fabulous place to be working. Wendell just talked a little bit about where they are. It's they're a little bit west of where we are, so we're just south of the Trans-Canada Highway. There's obviously infrastructure that's been brought into the district as part of the Huckleberry mine itself, including a power line and road. But even on our tenements, there's forest products operators that are harvesting timber there, driving new roads and bridges into the area, et cetera, which we are able to benefit from. So it's a very low-cost place to be working. Again, even higher level, there's a lot of other things going on in the area, construction projects, including TC Energy's recently completed $14 billion Coastal GasLink pipeline, which is just north of us. Artemis are building the Blackwater mine a little bit to the east, and Rio Tinto have their aluminum works in Kitimat and Camano just to the west of us here. So very sort of well-developed, industrial-rich part of BC. And of course, with Huckleberry having operated there, no issues in terms of exporting con along these roads and to ports to the west of here. So the SURG project, as I mentioned, our flagship asset, we put out a maiden 43-101 PEA here in June of last year. This is an asset that dates back to Kennecott and Placer Dome. A company, a couple decades ago called Terrain Minerals did a fair bit of drilling and metallurgical test work, but through M&A transactions, it sort of fell into being shelved with a few prior operators. So we've dusted this off, reimagined things, did some drilling, did some resampling of old core, and put out this maiden PEA last year that is really positioned as a large-scale copper porphyry development project, which we think is one of the most attractive ones in North America. So just running through the numbers real quick, M&I resource base of about 1 billion tons. The component of that that's in the mineable inventory is just under 1 billion, 1.1 strip ratio, pre-production capex of about just under 2 billion Canadian, which gets you a 2.1 billion Canadian NPV 8, total life of mine copper equivalent payable production of 5.8 billion pounds over 30 years, translating into about 350 million Canadian annual free cash flow. and about 191 million pounds annually of payable copper equivalent production for an after-tax IRR of about 20%. So large scale, long mine life, very competitive in terms of overall economics and unit costs. It is a multi-metal porphyry deposit, so copper is the main driver with 64% of the revenue contribution. Moly's the next biggest at 26% revenue contribution, and the balance coming from silver and gold. Numbers might be hard to see on the screen here, but this is just showing the metal price sensitivity. So again, base case numbers in the middle, 2.1 billion Canadian NPV and 20% IRR. Today at kind of spot prices for these metals, you're looking at about 3 billion NPV and 24% IRR. But even at very, very low ends of the price ranges here for both copper and moly, the economics hold together quite well. So we consider this to be quite robust under a range of sensible, reasonable metal price assumptions in energy transition scenarios that we're all focused on. I think another key selling point is the kind of design simplicity of the project. So we consider this to be quite simple. It's a single large open pit, crusher located adjacent to the pit, electrically driven overland conveyor moving crushed material to a concentrator with a off-the-shelf traditional sulfide flotation flow sheet producing copper cons with byproduct precious metals, and then a separate molybdenum con. Designed from first principles to electrify as much of this as possible. So the conveyor obviously would strip out portions of a fleet, less diesel usage overall. Connecting to the grid in BC, which is entirely hydro, would of course result in a very competitive and low carbon emission footprint per unit of metal output. Just a couple pages here on wider context for how does this fit into the competitive landscape of similar projects. So this is just a look at copper porphyry belts in Western Canada. The dark ones are the mines in operation. The lighter ones are development stage projects. So I think at this stage, our resources, as I mentioned, are largely in the measured and indicated category, which is what's being plotted here. Grade profile for all these open pit deposits are going to be roughly the same, kind of in the 0.3 to 0.4% copper equivalent range, which is possible to do in Canada given the low cost associated with good infrastructure, cheap power, that sort of thing. So we're not an outlier in that regard, but it is sort of one of the largest resource inventories today in Canada that is independently owned, so we don't have any sort of partnership level control at the asset level. In terms of the flip side of the competitive landscape, just looking at the investable universe of similar staged projects. So these are all single asset juniors with large scale porphyry development projects and recent economic studies. So this would exclude other companies out there that are in the kind of exploration resource delineation stage, or projects that have a economic study that's maybe a few years old, and some of the cost numbers might be a little out of date. What I'm doing in this analysis is normalizing NPVs and IRRs on an after-tax basis to $4 copper, so that they're all largely on a like-for-like basis. I won't go through the individual names, but you can see at the very bottom there how SURG's Berg project compares to the median of this peer group. So, across the spectrum there, longer than the median mine life, larger than the median recoverable copper equivalent over that mine life, middle of the fairway in terms of life of mine CapEx and NPV and after-tax IRR, middle of the fairway for capital intensity ratios like NPV to CapEx and CapEx to copper equivalent. But where we start to really deviate is valuation. So in terms of some of these multiples like enterprise value to project NPV or enterprise value to recovered copper equivalent, huge deviation from the peers. And this is plotting those two numbers, kind of busy charts, but suffice to say there's a couple outliers here, which are the logos at the top of these charts. And the lines there are just regressing the data set. So if you look at the dotted lines here, that's the regression on the data set excluding those outliers, and you can see that we are way off of that line. So if we were to re-rate to be in line with the majority of those peers, where the project is quite similar, as I spoke to on the prior page, there's sort of a multi 5 to 7x return potential just to line up back with our peers. In terms of speaking to our track record over the last few years, as a board and management team, we're quite focused on really disciplined approach to financing the company and deploying capital, most of the dollars going into the ground. So since 2021, we've raised a little over $20 million in a series of different financings, with majority of the proceeds going into things like drilling off deposits, updating resources, putting out new PEAs, etc. This is just sort of one look at a fundamental value metric per fully diluted share outstanding and how that's progressed over the last 3 years. So we've significantly grown the measured and indicated category copper equivalent pounds per fully diluted share over the last 3 years at about a 67% CAGR. So an investor that didn't participate in any financings and kind of sat there through that period would, while being diluted, would have seen significant growth in per share metrics such as this or other similar kind of fundamental value metrics. Just briefly on copper, we all know this, but it is the kind of fundamental metal at the heart of the energy transition. Very strong position in terms of substitution risks. Huge trends that have been underway for a long time around urbanization and infrastructure investment. But of course, the new things being renewable energy installations, electric vehicle adoption, etc., being a huge driver of all this. BC is a fantastic place to work. Stable fiscal regime and jurisdiction, world-class infrastructure and human talent, no issues with water resources or anything like that. Renewables dominant energy infrastructure, etc. So, great collection of multinational companies that are working there already today. Lastly, very quickly, we announced a $5 million funding package recently, including a strategic investment from African Rainbow. That's going to be deployed towards a bunch of technical programs to get the Berg project in a position to complete PFS in 2025. So a bit of drilling, bit of geotech, metallurgy, etc. All of that focused on the Berg project. Just going to stop there for time. Thanks, though.
Thank you. I think we might have a minute or two if anyone has any questions. No? I really liked the slide, I think it was slide 9, where you were comparing the economics with other projects. Would you mind, that was obviously a lot more economic focused, but what's the difference in terms of grade and resource size in comparison with some of those other companies that you listed there?
Can I go back here? Is that possible?
Yeah, click the red button. It should work.
No, it's not working. Oh, there we go. Yeah, I mean, so these are all open pit projects for the most part. We've got a few like Ivanhoe that are underground. So, yeah, look, I mean, off the top of my head, grade is going to be probably in that kind of 0.3 to 0.45 range across most of these peers. Again, depending if you're talking about an open pit resource model or an underground block cave. So yeah, I mean, I think the PEA or PFS economics, as highlighted here, would probably be the most kind of all-encompassing, comprehensive number that's going to include, cost metrics and recoveries and payabilities and all the different kind of factors that go into these things.
Okay. Perfect. That's time. Thank you very much.
Cheers.
Cheers.